Hey, it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. Let's take a look at some afternoon financial headlines. We'll first bring up the big board here. Green across the board. The market is up. The Dow is up 117, 118 points. Not a huge day, but not a bad day. NASDAQ up just a little bit. S&P up. S&P actually up quite a bit. So, yeah, so kind of a middling day, not a huge day, but green. And of course, little caution today, of course, as we head into the CPI number tomorrow at 8:30 a.m. We will be live for the CPI tomorrow. We're expecting non-core CPI to be again at 4%, which I think is the number that I think we should be looking at, the year-over-year core number. Did I say non-core? I meant core CPI. So that's coming in tomorrow at 8:30. So I think there's a lot of hesitancy for any big moves today. Plus, on Wednesday, we have the Open Market Committee meeting. We have the Statement of Economic, the SEP is what they call it. Plus, we have Powell, and I think he's going to do a Q&A after the 2 o'clock thing. So we might also be live for that. I wanted to cover some. So we have a busy economic 72 hours ahead of us. So not a lot of movement on the Dow or the markets writ large today. Even some of the bond markets, which were newsworthy, and we're going to talk about some of the bond markets today, they didn't move a heck of a lot either. Let's talk about one of the biggest stories that is over at CNBC. It's definitely a real estate story, is relative to Wells Fargo. So Wells Fargo is in hot water again with the Consumer Financial Protection Bureau. You might remember the CFPB, basically the brainchild of Elizabeth Warren. And here is the headline about Wells Fargo this morning. Regulators caught Wells Fargo and other banks in probe over mortgage pricing discrimination. And so what the allegation is here is relative to discounts. So if you're a mortgage officer over at Wells Fargo and you have a applicant who might not do business with Wells Fargo because they're saying, hey, I have a better offer over at XYZ Bank. Wells Fargo, can you meet or beat my offer from Rockland Trust or Bank of America or wherever? And in that case, you would have to go to a supervisor and basically say, hey, can we do a little bit better on this loan? Just like buying a car, right? Right. Go talk to your manager. And the thing is that they give out these discounts, and because it's a fair housing situation, there's supposed to be tracking on that. And for the tracking that they do have, from what we learned from the CFPB today, is Consumer Financial Protection Bureau, is that a percent that were received by African-American and women applicants was lower than the percentage of discounts received by others. Now, when you hear that headline right off the bat, you're like, ooh, Wells Fargo, they're racist. Basically, that's the conclusion that you should draw. But let's take a deeper look on this story. They received an official notice from the Consumer Financial Protection Bureau on problems with its usage of rate discounts. They hired a law firm, blah, blah, blah. And according to the CFPB, statistical significant disparities in rates in which Black and female borrowers got pricing exemptions compared with other customers. In other words, discounts. Let's go into a little bit deeper here. The practice, used for decades across the home loan industry, has triggered regulators' interest in recent years over possible violations of fair lending laws. Black and female borrowers got fewer pricing exemptions than other customers, the Bureau found. Here's the problem with anything that I've looked in on this story. Any detail that you find on this story doesn't answer this question, which leads me to believe they did not control for it. Excuse me. So, yes, they seem to have found a lower rate of discounts for African American and female applicants. But unless you control additionally for their credit worthiness to begin with, and unless you control for that, then it's not discriminatory. It's plainly not discriminatory. Unless you just control for the credit worthiness of the application, you cannot hold Wells Fargo responsible for the credit worthiness of the applicants. It's the applicant's problem or society writ large, but we cannot blame Wells Fargo for that. And nowhere in this story do they actually indicate, and none of the other media that I've read actually indicates that they controlled for the credit worthiness of the applicant. In fact, if you were to not control for the credit worthiness of the applicant and therefore also insist that the percentage of discount be the same, that is discriminatory. Some people might call that equity, but that is actually discriminatory. If you're giving out discounts at the same percentage and you're not taking into effect the creditworthiness of the client, that is discriminatory, right? That is absolutely discriminatory. So the problem here is the statistics. Wells Fargo, by the way, is up until recently the biggest player in U.S. mortgages and repeatedly felt regulators' wrath over missteps in home loans. So you might remember, and I was kind of critical of Wells Fargo in doing this, they basically pulled out of the mortgage business and they decided that they were going to focus their loan portfolio on African-American clients almost exclusively, if I'm not mistaken, as part of the renewed focus on supporting undeserved communities through our special purpose credit program. We have spent more than $100 million over the last year to help more minority families achieve and sustain home ownership, including offering deep discounts on mortgage rates. Wells Fargo is already offering deep discounts on mortgage rates, especially for African-American applicants. And this has been now their focus for the mortgage business. They're already basically doing everything that the CFPB and Elizabeth Warren would want them to do. But yet, here's another huge headline that says basically, read between the lines, Wells Fargo's racist. So the stats to prove that they're somehow discriminatory just aren't here. They're not here because they're not controlling for the credit worthiness of the applicant. The more and more I do a show like this, the more and more I understand that the financial news media doesn't really I thought the political news media were lazy, but yeah, where's anybody's critical thinking skills? Just boom, gone. All right, let's move on to another real estate story, and that is Macy's. Macy's is mulling a buyout offer for $5.8 billion. $5.8 billion for Macy's. And this is a real estate deal. That's what this is. In fact, not too long ago, Macy's actually considered changing its corporate structure to become a real estate investment trust, because the real value in Macy's are two things, basically. The real estate that they own, and they own a lot of real estate, and they're also their online business. They do a significant amount of online business that doesn't get a lot of attention, and they probably should get more credit for it. But it's really a real estate situation. Let's bring in Yahoo Finance here to describe that for you.
They are higher by about 15% on news that the company is weighing a $5.8 billion buyout offer. The proposal comes at an interesting time for the retailer, smack dab in the middle of its critical holiday shopping season and just weeks away from a planned CEO transition. So, is the deal worth considering? With more.
Arkhouse, by the way, is a real estate company. They're the ones teamed up with Brigade Capital Management.
We're now joined by David Swartz, who is the Morningstar Senior Equity Analyst. David, let's start there. Is this deal worth considering for Macy's?
Yes, I think it is worth considering. I think there's a lot of risk if Macy's turns it down flat because you never know when these kind of offers will come by. Now, $21 a share is kind of low. It is lower than the value of Macy's real estate. But you also have to remember that Macy's has $2.8 billion in net debt. It has a history of very uneven results over the past.
They had a portfolio estimate about 3 years ago saying that their portfolio is worth about $20 billion. But any mall locations that they used to own have probably even declined further in value. Shopping plaza locations even further in value in the last 3 years, right? Shopping plazas are even deader than they used to be.
15 years, really. And the model at Macy's just doesn't work anymore. And so it really is important for Macy's to take this offer seriously and potentially try to get a better price for shareholders.
David, do you think this type of offer, because we're seeing shares in Nordstrom move higher on this,
Macy's is up 15% on this offer.
This unleash, a wave of activity for old school iconic department stores like a Macy's, like a Nordstrom that own a lot of real estate? Now we're going to see those buyers step up in here and putting in bids.
Well, that's very possible. We did see Kohl's go through a potential buyout process a couple of years ago. That did not end in a deal. And if you look at Kohl's stock price since, it's way below where it was at that time. It's far below the offers that were.
Right. So if Macy's passes this up, then, the market's going to be like, dude, you just missed a huge opportunity. And again, Macy's shares are now surging about 15 or last time I checked, it was 15%. They have it here at 21% on this headline. That was from late last night, I think. So I don't think that sustained itself. But the thing is with this offer is that you've got to realize what they own. Let's take a look at that a little bit deeper here. Macy's retail department store trades under the stock sticker M. Let's look at here. It has had a roller coaster ride in the past 2 years with trade shares down now minus 32% for the year. Iconic department store chain brought Santa Claus into the mainstream, has emerged from the pandemic as a well-oiled machine. Has it? I don't know about that. Further down, let's go down as far. No, thank you. Let's go down as far as possible. Here we go. Discussion of the real estate portfolio. While Macy's operates 700 physical locations that include Macy's, Bloomingdale's Outlets, and Blue Mercury. Blue Mercury? I don't think we have a Blue Mercury around here. It also owns many of those locations. So like McDonald's, it's kind of a real estate business. Some of those highlights include its iconic 16-acre Bloomingdale's store at South Coast Plaza, plus its crown jewel, $2.2 million square foot Herald Square location, which takes up an entire block. The Manhattan location itself is worth $3 to $4 billion. And yeah, here's the estimate of Macy's real estate portfolio in 2020. It was estimated at $20 billion. Of course, as that guy said, they have about $3 billion in debt. And probably that $20 billion, if it's in shopping plazas, probably isn't the $20 billion that it was in 2020. Even with inflation, shopping plazas, I think, have declined again in value. In 2020, Macy's real estate holdings to be worth about $6 to $8 billion alone. So the valuations have been wildly, there's a big difference between 6 to 8 to 20, wild variations between these numbers. If you're not familiar with the downtown or Manhattan location, so to speak, it is right off of Herald Square. In fact, I actually stayed at the hotel, right, this little Hilton Garden here on West 35th Street. I stayed there about a year and a half ago. It's right around the corner from Penn Station and Madison Square Garden. You all know, I mean, this location, it's iconic, right? The Macy's parade, the Macy's, they own the whole block between 6th and 7th Avenue. It's quite an operation. But all of this is a real estate deal. When you look at some of the things that have been done with shopping plazas. Maybe you've seen this in your part of the country, but let's just take the mall, for instance, where I grew up, which used to have a Macy's. This is what it is now. They've now torn down the old mall, or 95% of the old mall, and built this type of different shopping plaza, which also has apartments way in the back. I don't know if you can see that. So this is a kind of a live, work, shop kind of experience. And definitely the architecture has changed in that instead of a mall where the building is in the middle and you park around the periphery, now you basically drive to the store that you want to, and it has more of a village feeling to it, if you want to call it that. Shopping, dining, leasing, where the stores are around the periphery and the parking lots in the middle. There's been a lot of situations like this one here. Demolition of Sears. Now, this is a Sears, not a Macy's, but this is also a mall very close to me here, where they recently, in the last 2 years or whatever, tore down the old Sears and Roebuck and built a giant apartment complex at that location because effectively the real estate was cheap and Sears was out of business. There's also a Macy's at this location. And I mean, come on, how often do you go to Macy's compared to, say, 10, 15, 20 years ago? Like, you don't. Have you ever been to a Macy's recently? There's probably some people, if there's anybody watching, which there is good, that you've probably been a long time. You'd be hard pressed to remember the last time you went to a Macy's. And it's ripe for all sorts of creative redevelopment opportunities, which costs money. And I think that's why a lot of discount might be applied to this takeover buyout number, is because while they do own a lot of real estate, it would probably have to be redeveloped, which means additional debt, which means that's why they would take a discount on the sorry, trying to run a business here. That's why they would take a discount on the real estate portfolio, because it has to be repurposed, as we just mentioned, like they did that mall up in Hanover, Massachusetts, like they did the Kingston one, all going to have to be repurposed for something else. All right. You've heard me talk a lot about the 10-year and the mortgage. You heard me talk a lot about the 10-year and how mortgage demand for the 10-year and for all of our borrowing has not been what it used to be. We're in the period of a long-term decline in foreign demand for U.S. debt. We're in a period of long-term decline of foreign demand for U.S. debt. In other words, there's not as many people who want to lend us money as there used to be. And we've been tracking some of this. And today we had two important auctions. One was a 3-year auction. And then a couple hours later, they had a 10-year auction. The 3-year auction went poorly, and the 10-year was okay. So the 3-year went off at 11:30 this morning, and pricing at a high yield of 4.49. The auction saw a big drop from last month's. Effectively, what they expected to get versus what they actually got, there was a huge tail for what they basically want to describe here. So when you look at these numbers, especially this bold here, foreign buyers accounted for just 52.1% of the auction today. That is down from 65% from last month. And there's an average on that of 64%. And it's the lowest since June of 2022. And direct buyers, 21%. Dealers bought, in other words, the people, the banks that run the auction themselves, the banks had to buy 26% of the auction. That's up from last month's number of 16%. And the average auction on that is, the average on that is 16%. So the dealers, the banks, were forced to buy 10% more than they usually buy because effectively there's not enough foreign buyers or weren't enough foreign buyers. The 10-year auction went slightly better. Let's take a look at those numbers. With let's see here. Where is it here? I was looking for the dealer number. The dealers here were left with 17.3%, also in touch with recent results. So in that case, it went better, but not great. Not great. It was an improvement. So a little bit better on the 10-year, but the 3-year auction was a train wreck. We are in a situation where not as many people structurally want our debt anymore. And the Wall Street Journal ran a huge article this past Sunday, why treasury auctions have Wall Street on edge. So you hear me harping about this on any number of videos that we've talked about here. And I'm not alone in this. I mean, here's the Wall Street Journal saying we should be concerned about this. This ran, as I said, just yesterday. I want to bring up this chart from the Journal and show you how much we are borrowing. And keep in mind, as foreign demand declines, the amount that we're borrowing is going up. Look at this chart. This is treasury issuance going back till 2012. And the pink is what we've borrowed so far this year. Now, did we have a pandemic this year? No. But when we're all done with this year, we will have borrowed more money this year than we did in 2020 when the pandemic hits. Look at the chart. We're going to borrow more money this year than we did on the year of the pandemic, testing the assumption that the sale of $20.8 trillion of new treasury in the first 11 months is set to surpass 2020's record of just under 21 million. So we're probably going to borrow more than 21 trillion. I said million. No, it's trillion, Jack. We're going to borrow more than we did in 2020. That's insane without a pandemic. And as you can see, it went down a little bit in 21. It went down, took another step down in 22, and now we're back up. And as you can see, I mean, if we went back to, let's just say, we were ramping up there a little bit during the Trump years, and the worst year of the Trump year was, say, let's just say, the worst year pre-pandemic, we'll say, was about 12 trillion. And so this year, we're going to borrow almost double that in an environment where fewer foreign people, foreign lenders want to give us money, where fewer people want our debt. That is not a good scenario. And next year, it's possible that we might even borrow more. So not a good situation. When we scroll down here and look at the distribution of how we're financing all of this, with what type of terms we're financing bills, bonds, and notes, bills being the shortest, bonds being mid, and notes being long term. Basically, what we're starting to do is skew our borrowing to the short term. And that's, how do I want to say this? That could be counter to what the Fed is trying to do. When you borrow a lot on the short term as the U.S. Treasury, that can be inflationary. And that's, of course, antithetical to what the Fed is trying to achieve. So in a way, the manner in which the U.S. Treasury is borrowing can actually countervail what the Fed is trying to do. And that's why I've been telling you that I think that the 10-year is going to go back to 5% maybe next spring. I'm no expert, and this is not financial advice and all that other good stuff, but I am not super enthusiastic or optimistic that we're going to see mortgage rates down to 6.1% or something like that. Because of our borrowing situation that looks more dire and more dire than ever. All right, we have another story. Let's bring it up here. from yesterday, actually. More retirement savers are borrowing from their 401k plan. Those are leading indicators of economic stress, experts say. Ooh, that is not a good move. More retirement savers are taking loans from their 401k over the past year, as they're borrowing more readily as they feel the pinch of inflation. And, I think what a lot of people have happened here is, and this is actually covered in a different CNBC story about living paycheck to paycheck, even people that are making $100,000 are living paycheck to paycheck. And what's happened here is the classic like boom and bust cycle where people get used to all this free money and all the stimmy checks and being able to make money easily. And then when there's a slowdown, people are like, whoa. And also, most likely during the good times, so to speak, when money flowed freely, you may have increased your fixed operating cost as a household. In other words, you have more things that you have to pay for, like car payments and that type of thing, and or you've adjusted your lifestyle to eating out more or whatever the things that you blow money on, to not be as frugal as you used to be. And now you're like, whoa, honey, we don't have as much. Yeah, we've run out of money before we've run out of month. And so people in a panic, they're like, okay, I need an extra 20 grand or whatever the hell it is. And they're tapping their 401k. I know here at my household, we have just made 3 decisions that are going to be huge for our bottom line. One of which has already got into effect in October, one which goes into effect in January, and then a third which will go effect in April. And these are when you combine them all together, they're big ticket items that that we're not going to continue on with. And we're going to be saving, effectively a huge chunk of money that way. One of which was kind of like a luxury, and we don't need it anymore. So we're just gonna scale it back. And the other thing is kind of like a productivity upgrade. So that's going to pay for that. And so that will be basically a savings. And the third thing was we shopped around for something and got a much better deal. I don't want to get into the personal part of it, but huge swing to our bottom line in 2024, because I think we had at our household definitely kind of like lifestyle inflation, kind of got used to all the free money and or that type of generous economic environment, and we dialed up some things that maybe we shouldn't have. So now we're gonna dial them back down. But we still have some fixed costs that we can't really get rid of, including the 2 cars that we bought in 2021. We needed cars. Did we need brand new ones? I don't know, but we definitely had to get rid of the 2 that we had, that for sure. So there we are. We definitely needed cars, and we solved that problem. That's when you buy a new car, that's a 10 or 15 year problem solved. So, and we definitely needed those. Did we need the ones that we had? Well, I needed the Bronco. Yes. The Bronco was a life necessity. My wife's car, we could have bought her some piece of used something. Oh, she's not listening right now, so I can say what I want. Shh. But we absolutely needed the Bronco. The Bronco your Ford Bronco is life, right? So it is life-changing. So that's it for today. Thank you so much for watching. We'll be back at least by Tuesday at 8:30 a.m. for the CPI number. Talk to you then. Go make some money. Have a great day. Bye-bye.